Hello everyone, welcome back to the channel. This is the final video of our playlist about Audit Universe creation. In the previous videos, we discussed what an audit universe is, how to build it, how to map processes, entities, and systems, and how to keep it updated. Now, we move to the most important connection of all, how to link the audit universe to risk assessment. Because honestly, an audit universe alone is not enough. It only tells the audit what exists inside the organization. But risk assessment tells internal audit where to focus. And this is where real risk-based auditing means. So in today's video, we will discuss how internal audit connects audit universe with risk assessment, how prioritization works, and how this supports audit planning. So let's begin. Let's first understand the big picture. Organizations usually have many departments. They have many systems, many processes, many projects, and many risks. But internal audit resources are always limited. You cannot audit everything every year. It's impossible. So internal audit must answer one critical question. Which areas should we audit first? This is where risk assessment becomes essential. The audit universe gives us the list of auditable entities. Risk assessment helps us prioritize them. Without risk assessment, audit planning becomes random. And random auditing creates weak internal audit value. The audit universe is the starting point. Think about it like this. The audit universe is the foundation. It contains processes, systems, business units, subsidiaries, projects, locations, and operational activities. But not all entities have the same risk level. For example, one factory may be high risk, another may be stable. One country operation may have weak controls, high fraud exposure, or political instability. Another may operate very smoothly. Risk assessment helps internal audit understand these differences. So, what is risk assessment? Risk assessment means evaluating what can go wrong, how likely it is, and how serious the impact could be. Very simple. Internal audit usually evaluates likelihood and impact, and sometimes control effectiveness. The purpose is which comes first. How internal audit links the two together. Now, let's discuss the practical process. Usually, internal audit follows some steps. Now, let's talk about these steps. Start with step 1. Build the audit universe. First, identify all auditable entities. For example, procurement, treasury, cybersecurity, payroll, inventory management, third-party management, etc., etc. These creates the audit universe. Step 2. Identify risks for each entity. Now, internal audit asks, what risks exist inside this area? For example, procurement risks, fake suppliers, overpricing, bribery, conflict of interest, duplicate payments. Let's come to IT risks, ransomware, unauthorized access, system downtime, weak password controls. This stage connects audit entities with risk exposure. Step 3. Evaluate risk levels. Now, internal audit evaluates risk levels. Usually, auditors assess impact and likelihood. For example, a ransomware attack may have very high impact and medium likelihood. A small manual error may have low impact but high likelihood. Both of them matters. But usually, the high impact risks receive greater attention. Some companies use low, medium, high scoring. Others use numerical models, for example, 1 to 5 scoring systems. The goal is to put all of them in order, not mathematical perfection. Now let's come to step 4. Consider existing controls. This is another important point. Internal audit should not only evaluate risks, it should also evaluate control strength. For example, two departments may face similar risks, but one of them has strong controls while the other has weak controls. This changes audit priority. Sometimes a moderate risk area with weak controls becomes higher priority than a high risk area with excellent controls. This is why residual risk matters, not only inherent risk. Step 5. Prioritize audit activities. Now, internal audit combines audit universe and risk assessment results, and finally decides which audits should happen first. For example, internal audit may discover cybersecurity risks increased, third-party dependency increased, inventory losses increased, or regulatory pressure increased. These areas may move higher in the audit plan. This is the essence of risk-based auditing. Now, let me give you a practical example. Imagine a retail company. I'm always giving a retail company examples because I work in a retail company. The audit universe includes stores, warehouses, SAP systems, e-commerce operations, procurement, payroll, and logistic vendors. Now, internal audit performs risk assessment. The results show cybersecurity incidents increased, stock losses increased, one country operation expanded rapidly, and outsourced logistics dependency become critical. Immediately, internal audit understands which areas deserve more attention. Without risk assessment, all areas may appear equally important, but in reality, they are not. So, what are the common risk factors internal audit uses? Now let's discuss the common factors. Internal audit often evaluates financial exposure, fraud sensitivity, operational complexity, transaction volume, system dependency, and many times management turnover, past audit findings, cybersecurity exposure, and business impact. For example, areas with large cash transactions, weak segregation of duties, and high manual activity usually receive higher risk scores. So, why dynamic risk assessment matters? This is another important topic. Risk assessment should not become static because risks constantly change. For example, 5 years ago, many organizations didn't heavily worry about AI governance, or ransomware, or cloud dependency, or digital fraud, because none of them are used 10 years ago. Today, these risks are critical. So internal audit must continuously reassess priorities. Modern risk assessment must stay dynamic. Now, let's talk about common mistakes. Always there are mistakes. Mistake number 1, treating all audit entities equally. Not all areas have the same risk level. Mistake number 2, only focusing on financial risks. Modern organizations face operational, cyber, reputational, and strategic risks too, not only financial. Mistake number 3, ignoring management insight. Management often understands operational pressure very well. Internal audit should listen carefully. Mistake number 4, using outdated risk scoring. Business environments change rapidly. Risk models must improve too. Mistake number 5, creating overly complicated scoring systems. Some organizations build huge mathematical models nobody understands. Simplicity and clarity are more important. Now, why this makes internal audit more valuable? Let's discuss the bigger picture. Why does this matter so much? Because modern internal audit is not about auditing everything. That is impossible. The goal is focusing resources where they create the most value. And that requires understanding the audit universe, understanding the risk landscape, and connecting them intelligently. This is what transforms internal audit from a checklist function into a strategic risk-focused function. So let's summarize today's discussion. The audit universe identifies what can be audited. Risk assessment identifies where the biggest risks exist. And together, they support risk-based audit planning, smarter focus, and stronger internal audit coverage. Remember this, internal audit creates the most value when it focuses on the risks that matter most to the organization, not simply the areas that are easiest to audit. Thank you very much for watching. If you enjoyed this video, please like and subscribe. And let me know in the comments what do you think.